General Mills, stock ticker GIS, is roughly down 22% year to date. Over the last year, they are down roughly 25%, and as many other businesses, they are affected by the macro environment. But is this a good time to accumulate shares for the long-term dividend investor? That is what we're going to look at in this video. Valuation-wise, they're looking pretty okay. A B+ on Seeking Alpha on the PE non-4 ratio sits around roughly 15, which is roughly 13-14% below the 5-year average. And if we take a look at the dividend stats, they offer a 3.62% yield, an annual payout of $2.36. Payout ratio sits above 50% roughly, and a 5-year growth rate of 2.9%. And a dividend growth streak of just 4 years. But if you take a look at the dividend streak, you can see a couple of years ago, they just had a stagnant and now non-dividend growth basically. So they actually had quite a lot of the history paying out dividends, but for growth-wise, they've only done it for the last 4 years. And before we do our intrinsic value calculations and discussion about the stock, I quickly want to check the financials. Obviously, we do want to have some steady growing revenue, and you can see they are doing that. Then come down to net income as well, also growing, which is really good. Let's jump into the free cash flow statement or cash flow statement. You can see a net income again up here on top growing, and then coming down, cash from operations sits at 2.8 to 2.8 roughly, so pretty steady. And the capital expenditures are rising a little bit, not something we want to see. But if we come down to the bottom to see the free cash flow per share, you can see it actually sits 3.43 and 3.78 5 years ago. So again, not growing that much. Looking at the balance sheet, you can always see in the supplemental items the total shares out on filing date. You can see 602 back then, 581 now. So they are buying back shares, which also is a way to raise the free cash flow per share. So indeed, it looks like the dividend is really safe going into General Mills. So let's take a closer look at what the Wall Street analyst thinks about it. And you can see here a lot of yellow. 21 analysts in the last 90 days. A couple of them has it as a strong buy, a couple have them as buy on the hold, and a couple on the sell side. So it's pretty diversified among the analysts. I think still a lot of them on hold, obviously. Coming down to a price target, a average price of $70 and 8% upside from the current levels. Obviously, I think with the recent acquisitions that General Mills are targeting, I think if they can navigate the macro environment, they are probably able to post some single-digit growth into the future. And it all depends on the execution of the management in that case, obviously. But let's jump into our stock screen and take a look closer. Let's zoom in a little bit more. So what we have here is the key metrics on the left, obviously. So earnings per share all looking pretty good. PE ratio below the mean as we saw earlier, and is growing the revenue. It's pretty close to the 52-week low actually, with the 52-week high being around $90. Net debt to EBITDA is looking pretty dim, I would say. The net debt to EBITDA ratio above 3 is not really what I want to see. That means that they are pretty over leveraged and are very, very sensitive to the Fed decision. So recently we saw that the Fed decided to hold the rate and are looking to cut it a few times into 2024, which is really good news for a company like General Mills. I think if the rate were to go up again, the stock price would most likely suffer more as consumer spending remains tight and obviously pushes net sales down. Obviously, this is also something like Wegovy and Ozempic and all the weight loss drugs. Yet to be seen how they affect consumer spending, obviously. But Walmart, General Mills, stocks like that, I think they have to be affected in some way or another, at least for some of their sales, since people are using Wegovy and Ozempic quite a lot for weight loss and obviously are cutting back on spending on food items. But return on invested capital and return on equity also looking really good. And I think all the margins are looking pretty good. Gross margin of 50 is really good. Profit margin of 12 for food stock, I think that's really, really good. Also, price to sales is really low. But you can see dividend stats again here, 3.72, 50% or 62, 50% payout ratio, a 3-year growth rate of 5, and a bit lower 5-year growth rate I saw earlier. It's also looking pretty good. Short interest is on the low side, but not that low again. So some investors are out there looking to push the stock further down. But let's jump into our dividend data tab here and zoom in a little bit more. So what we're looking for here is basically some steady growth. And as you can see here, basically up and down, and some, I think there have to been a minor mistake or something here of the data that gets imported. It's via a API, so I don't really have any control over the data getting in. Basically, I just can take a look at it. So what you can see here is basically I don't expect it to go up by 35% and then be cut by 17%. So again, I think this looks a little bit odd. But what we're looking basically at here is the dividend growth rate over the last 5 to 10 years is pretty steady around these 4%, and I expect that to be the same in the future. Coming down to the dividend yield theory graphs, you can see here, whenever we move into the blue area, it looks undervalued, which is, according to the graph on the left here, roughly 8% at the current time. So you can see here, it actually was very undervalued at some point, and then all the way down. So it really depends on if they keep pushing down here or how this will go into the future. Obviously, we don't know about that. But we also have a lot of other intrinsic value calculations, such as a discounted cash flow model. Let's zoom out a little bit more. And then you can see I applied a growth rate of 4%. I think this is a bit up because they were really hit, as you can see here, up in 2023 on the free cash flow. So I think in this case, and also for the price to free cash flow ratio, I think this is a bit bad to keep this one. But let's go through. You also have the dividend discount model, the multiples valuation, the Graham's revised valuation model, price to earnings model, and free cash flow variation, as mentioned earlier. I also think this is a bit misleading. Last one being the Peter Lynch model. And before we jump into the summary, thank you so much for watching. If you haven't done so already, please subscribe to the channel for more videos in the future. And now let's jump into the summary and take a look at all our valuation methods and also our margin of safety calculator. So as mentioned earlier, you can see here, we do have the discount cash flow and the free cash flow model. You can see those two are the two lowest ones, and the average intrinsic based on all of them is around 57. With our margin of safety calculator over here on the right, one being net debt to EBITDA, and also the operating margin isn't growing, is actually adding back a bit of margin of safety. So if we use these 20% and put over here, the acceptable buy price becomes $46, which is quite low compared to the current price of $65. But if we try to take away these free cash flow dependent valuation models, such as the discount cash flow and the free cash flow variation, then suddenly we come to an average intrinsic of around the current price actually. So that makes a bit more sense, at least compared to the dividend yield theory, and also the current price being 65. So we are roughly in line. Still, a margin of safety applied or 20%, then the acceptable buy price become 51. So still, it needs to come a little bit lower for me personally. I think there are some risk factors. As mentioned earlier, we do have these weight loss drugs emerging quite a lot, and it continues to raise some concerns among investors, at least with the popularity of these drugs. Obviously, stocks like Eli Lilly, Novo Nordisk, and so on, they are massively on the way up due to these due to the sales of these drugs, obviously, but Costco, Walmart, Kroger, and so on, they are also affected in some way, shape, or form, and I also think General Mills would be the same. Again, if something happens inflation-wise and we see a risk of a recession and some tighter consumer spending, that also would continue to pressure businesses like General Mills. So for me personally, I think they have maybe some headwind, potentially headwinds at least. I think the management can probably execute on the expectations on acquiring a snack company they're looking into and then growth that way. I don't think there's too much growth to be had organically, to be honest. But I think they do have a very impeccable track record of steady dividend payments, and I think they are keeping out to keep that going as well. So for me personally, it's all about the management being able to execute on the strategy to do more acquisitions to help the growth that way. With the recent announcement of Fairer Pets, I can see they are capturing some growth from the increased pet spending in the foreseeable future, but it remains to be seen if it's actually something to really offset the big changes for General Mills and to reverse this very downward trend they are having at the current time. It remains to be seen. I'm not 100% convinced yet. I will be waiting a little bit. I will definitely join all the other investors or analysts basically here on hold. If you have it, fine, keep it. It's a pretty good yield and a pretty good income stock. But if you're looking to buy, I would definitely wait out a little bit. Thank you so much for watching, and I'll be seeing you in the next video.